Hey everyone, happy Sunday. Hope everyone's having a great weekend. Wait for a few more people to jump on before we crack on. Thought we'd do something a little bit different today. We're looking to cover market data that comes out. The difference between your tier 1, tier 2 data points that come out, how they can affect different markets. As I know a lot of people don't really pay attention to the data, they maybe note when it's coming out, but they don't really factor in any of the numbers and their true feel is for technical analysis. So we're going to look at challenging that ever so slightly today. Not saying you need to be changing your complete outlook, but I definitely think it's important for you to know when data points are outliers and how that can basically impact the order flow for that session that comes in, for example. And we're going to run through some of the key numbers that come out on Thursdays and how you can prepare yourself for the numbers that come out. And ultimately, the market is really never wrong because it needs to reprice when these numbers come in, especially if they're out by a number of standard deviations or just out of whack. And we're going to show you very quickly how to determine that so you can be prepped. So let me know how you're doing. Um, but in essence, the reason why I don't typically use Forex Factory, I just think it's a nicer way to look at the numbers. I use Financial Juice as the main data that comes out uh, to monitor things, as I use that for the squawk. And very typically, when you're doing this over time, you realize what data that comes out, um, if the market basically shrugs it off or not. And then you realize sometimes when it goes one direction then snaps back, and that's normally just due to the data being a little bit in line and not really out with any standard deviations. And we'll run through a couple of examples of that that you can see. Now, all of this is going to affect specific markets. So I typically execute on treasuries, whether that be the 10 or 30 year, or bonds in a 10-year note, which typically runs opposite to currencies and to equities. Equities is a little bit of an outlier in terms of that. So what we're going to run through just very quickly here. So you obviously have these data points that come out every day. Now, bearing in mind, I'm in the UK, so this is the UK time. So this is 5 hours. I'm 5 hours ahead of the New York session, so you need to bear that in mind. And very typically, when this comes out, if you don't have a clue what any of these are, you can go into these and it'll in essence tell you for core retail sales that in essence this is the sales that has happened on a consumer level that um, excludes car sales or automobiles in essence, because that has the most volatility in retail sales across the board. Okay, and then very, very quickly, when you're looking at these numbers, realistically, unless you've done any form of research, you've got absolutely no idea what 0.4%, this is the actual number that came in, the forecast was zero point 0.1 and the previous was zero point 0.5, okay, and it tells you that that was revised from 0.4%. But unless you've done the research, now I'm not saying you're going to be, extremely going in depth of this, you're just going to look at the ranges, right? But you need to understand what 0.4% actually means and how that's going to impact the market when it comes out, okay? Which makes a big difference. So, how do you see that? So, core retail sales at the time when it came out, it was 0.1% forecast. The previous was 0.4%, revised to 0.5. Okay, so you can press this here, and this gives you all the numbers that in essence came out. Okay, we're going to change, you can change the range because you want to see it within the last 2 years to see how this is actually looking. And what we have here, we have the blue bar is actually the number that's came out, and the orange is the forecast. Okay, so if we look at this from the year prior to this data point coming out, okay, the highest for this year was 1.1%, okay, and the lowest, if this would click, is 0.6% for this year, okay? So that's the range, right? The range is 1.1% to the upside and 0.6% to the downside, okay? The market is forecasting in for this report 0.1%, okay? However, you can see the last previous few months it's been relatively stagnant with a good beat the month before, okay, at 0.4%, okay? So you want to be saying things like, right, okay, if this market comes out and we get another beat on forecast that comes out, or it's way, way below, for example, we beat this number where it's less than 0.1%, how is that going to impact the market, right? So you then make a note. So for example, if the number comes out above forecast, right, and then say we hit 0.4%, or we have another month that is showing an increase in consumer spending, that shows that the economy is pretty strong, right? Which then that impacts the Fed's decisions. If an economy is pretty strong and it's showing growth where people are spending more money, then that is giving the Fed an indication that maybe interest rates are actually, okay where they're at the moment, right? Which then typically this impacts the dollar in a bullish manner, okay? Stocks is a bit of an outlier, it really depends, but typically stocks like a growth environment, they tend to go bid in that environment. And then typically this will help yields. Yields will be increasing, and then ultimately for the markets that I trade, a stronger economy essentially has a negative impact on bonds and notes, so they tend to sell off in that nature. Okay, so you're working out what the ranges are going to be here, and then you're realizing that if it is a beat above, say, 0.4%, right, or in line with that, then that's going to be either good or bad for your respective market. Okay. Hey, dude, how's it going? I thought I would do something a little bit different today, mate. I find it easier to do things off the cuff rather than this, editing and all this sort of stuff. I'm not an editor, so I find it easier to do this way. So this is the core retail sales. Now, the only difference between core retail and actual retail sales is core basically excludes automobiles, and retail sales has everything in it, okay? So if you note these numbers, for example, you're just making a general note of for this year, the most negative number has been 0.6%, negative 0.6%, the highest has been 1.1%, so you're somewhere in those range. If this was below 0.1% with this number that came in for me, then you better believe I would have been buying bonds, right? Now, if we jump into this, now this is where the outlier came in. This is where it was an absolute shock to the system. Market repriced, equities went bid, treasury sold off on this number. So we'll look into this, right? So you can have a look at this. Now, very quickly, you go into the range. You set the range to 2 years because you don't really care what happened in the last 3 or 4 years. You're looking to see what's happened in the last 12 months. Okay, so prior to this number came in, right, retail sales was forecasting 0.4%. The last number that came in, right, was 0.2% negative, okay? It revised to 0.2% from the previous number coming in flat at 0%, okay? Now again from this, we see the lowest number. This is a little bit buggy here where this presses. Okay, we've got 0.8% for this year being the lowest, and then the highest that come in for this year, this would press so you guys can see it, is 0.7%. Okay, so that's the range. We have a 0.7% is the highest come in for retail sales this year, and the lowest is being negative 0.8%. Okay, so that's the lowest and highest range that you're seeing. Okay. Now you can see where the market is forecasting in. It's been forecasting somewhere around the sort of 0.3% mark, right? Roughly, give or take that range. This number came out and it's the highest print this year, right? It came out at 1% here. This is the actual print. So when that comes on the wires, right, you're noting the ranges for the core retail sales, excludes automobiles, and then you're noting this. This is the highest print that it's been that year, which again shows a much stronger economy than what the market had already been pricing in, considering this is the highest print for this year, right? So you're noting that, which is extremely important in my opinion. And you know that the Fed right now, if you've been listening to any rhetoric from them, that they're extremely focusing on the unemployment numbers that are coming out. In essence, how many people are employed, how many people are not employed, how many people are essentially on and claiming welfare, and what job openings are happening. Okay, this is the key numbers that then came out. And from this, we'll set the range for this again. Okay, so we can see that the market for this year, again, you're just going through, this comes out a lot more frequently, this data. So you can see that in the last number of months, okay, there's been more people essentially unemployed or putting in unemployed claims in there, and the market was then pricing in 236k. And then with this number that actually came out was 227k, which is the lowest it's been in the last, say, 4 months. So this data that came out was extremely good for the economy for for these specific data points, with the highest print for retail sales, a beat on core and retail sales, and then unemployment essentially had dropped for that specific month. And what you'll see for that is the dollar goes bid, so does indices will go bid, and then treasuries, if you look at the charts from that day, they absolutely dumped on that session the whole way from the curve, because they have to quickly reprice on these numbers. And what you'll typically find is these numbers on a session basis will direct the flows, because traders need to basically adjust their bets for if the Fed is going to cut, or by how much they're going to cut, or if they're not going to cut at all. It's pretty much what you need to take into consideration. Okay, and you can do this for any of the data points that are coming out, and you need to then be making a note on um, how much of an impact do these data points have. Now, just very typically, if it's going to be a tier one data thing like NFP, CPI, PPI, unemployment claims, retail sales, you've got Michigan sentiment that also has a good effect. We had the housing starts and the building permits that came out on Friday, that actually were the least amount of housing starts and building permits granted this year. But the market didn't really care, to be perfectly honest with you, especially not in treasuries anyway. Um, so yeah, you just need to journal all of this, and I think it's extremely important for you to see these numbers when they come out, and give an understanding that at least in treasuries, if these numbers come out, you're certainly not going to be buying the knife, back up, if that makes sense, you know. And if once you get efficient at this, you can essentially, if you realize that these numbers are, extremely out of whack, and the market needs to reprice, you can comfortably go in and just hit the bid or lift the offer depending on the market that you're trading. Okay? And then you should be on side, if you're realizing that these numbers and you've done your prep and these numbers are, is way out of the norm, you can be quick to it. You could be instantly 6, 7 ticks on side when you're hitting these trades. Now, does anyone have any questions about this at all, as to what you're seeing? Let me know. And if we go to the likes of CPI that came out, okay, CPI was a bit of a weird one actually. So CPI effectively came in completely in line, and actually we had inflation went down just a little bit. from there, year on year. And I remember looking at this when Treasuries actually sold off initially, and I just wasn't buying that because the numbers were not significant enough to show a complete dump, which is why basically you just had a bid straight back up. And that's the reasoning for it is people begin to reprice instantly, and then you need to make a decision depending on how that data is going to impact it. Am I saying that you're gonna trade this solely and not take into account any other order flow? No, you're not. You know, I think it's very important for you to know these flows because you better believe large traders and institutions are at the desk and waiting for these numbers to come out. Okay. And you can do this for the following week as well. So you do your prep in here. If we go to the next week, next week is relatively light for Monday, Tuesday, and Wednesday. We have the FOMC meeting minutes. Now, to be honest, you can't really do too much prep about this. You'll just get a gauge of it over time. And it is pretty late in the session. It's coming out 2 p.m. New York time. So really, you should be done by then anyway, to be honest with you. But you need to watch what they're going to be saying. But the numbers are not really going to change. They're still trying to get inflation down to the target. They're still cautiously watching the labor market that's coming out. They'll probably say something like, "Oh, we're great to see how uh, retail sales had a beat and unemployment essentially ticked down." That'll be part of what they'll be putting in the minutes. And then, of course, on Thursday, we have the PMI that comes out and more unemployment claims, which you need to be seeing how that changes versus last week's numbers that come out. And again, for you to do this, you then go into the graph. You then can set the range if you want to even do it for last year. You can then see that this number here is in essence what was happened last week. So you know what the high is, you know what the low is for the specific year, and then you can factor in, is this within a reasonable amount, or are we way out of a norm? And then you can act upon that because everyone else will be. So I think it's important for you to actually know these numbers that come out. And very, very typically, you're just going to be noting something like, okay, in the last 6 months, 215K has been the low, and then the absolute high, which is seen here, is 249K. So how does that affect your specific market? Pretty much. Okay. So very, very, very typically less unemployed or less unemployment claims, so people basically filing for welfare. The less people means it's a stronger economy, more job openings, more growth, you know, which is going to be ultimately good for equities, good for currencies, good for yields, and bad for bonds. The opposite is then in effect. If you see a really, really high print, then that's going to be bad for yields, bad for the currency, typically going to be bad for equities, and it's going to be good for treasuries. And that's very typically it. It's not nothing extremely complicated about this. I just think that so many people don't even take it into consideration when you see the market dumping off and you've got a trend line drawn, and then you see hit the trend line and then you're buying it, for example. Um, Most likely that's going to be taken out because the market needs to reprice in. The technicals when these data points come out are almost the last thing that should be respected. Unless you get standard deviations away and people need to start taking profits, they start fading it back into somewhat of a mean from there. So ZN, how much emphasis do you put on the 3-star red news numbers, or is there a large miss? Is it possible for treasuries to move in the opposite of the expected direction initially? Was originally taught to just read the flows? So very typically, this is where you'll learn this, and that's why I brought up the PCI number that came in. If everything comes in line, the market is never really wrong. It's normally the Fed that's wrong, to be honest with you. Either they're too late or too quick to cut, right? And when you seen with that CPI number that came out in respect to treasuries, the number pretty much uh, the number pretty much came in line. To be honest, yet treasuries sold off quite a bit, which in my opinion, when that came out, and I was thinking this shouldn't be selling off. Everything's in line. It's already priced in. If anything, the numbers are pretty good for treasuries. To be honest with you, um, because they need to start cutting. So you can in essence be a buyer, but it all depends on how far that moves out of a standard deviation, to be honest with you. And the only thing I can say is you work out these averages, right? You know what the high and low is for the year and where things are going to be a shock for the data points that come out, and then you just watch the flows that come in and you'll get an understanding of it. Another one was when Michigan sentiment came out on Friday. Michigan sentiment came out a beat, which in essence is saying that consumers think the price of goods and services are going to increase over the next 12 months, which in essence means inflation is going to be higher, so which is bad for bonds. And then you had a continual sell off. Hello, Pikey boy, how's it going? So I just think it's you need to be aware of the flows. I mean, don't get me wrong, you can, like, when that data came out on Thursday last week with the retail sales and unemployment numbers came in basically better than expected. You can see the flows that it's aggressive selling that comes into bonds and those. But is it not beneficial for you to know why that's selling? You know, like why is the market absolutely dumping rather than just knowing, okay, like there's selling flows coming in, because then overall you understand the context better, and that is the part of trading that you need to get is context. And very typically on the session, if the context doesn't change, you need large traders to step up and basically absorb a level for the context to stop. You know, and that's exactly it. The context is the key. And the thing is, you need to decide yourself, because typically the market is extremely efficient, right? The market doesn't just sit stagnant and wait for these numbers to come out. It's already trying to price in these numbers. These guys have got analysts that the job is to try and get within a certain range of what these numbers are going to be. You know, not saying that they can't predict the future, but they'll have AI running at the minute that will give them something within a 90% confidence interval of what these numbers are going to be. And if that number beats those confidence intervals, then ultimately the market needs to reprice in, whether that be large traders, institutions, algorithms, whatever it happens. And very typically, when you see these numbers that come in that are a shock, the short end of the curve aggressively reprices, which is why when you go and you look at the likes of the 2 and the 5 year, it moved aggressively versus the likes of the 30 year didn't move as much, because obviously the short end of the curve is more volatile for the more recent data points and fluctuations that come in the market. I don't really pay that much attention to gamma levels. at all. Especially not in bonds and stuff. I think they would maybe have a little bit more relevance in in ES and NQ. Yeah, so it's a good question, Pike. If you basically buy them, you get the amount that you get the coupon amount for the period of time, and then you get your money back at the process if you hold them to maturity. But if you sell them prior to that, then you lose what the market is. The whole point of a note and bond is you buy it and you hold it to maturity. Yeah, exactly. But we're trying to. I think the main idea behind discussing this is so that you understand the sentiment and flows that come in that day and why. Um, because very typically, if you're not aware of the flows that are coming in and why the market's repricing, and it gets to I don't know, a point of control, for example, and you're buying the point of control, maybe you shouldn't. You know, maybe you should be selling because of that data comes in. You know, you can see that in the flows, but I just think the context is extremely important from there. And to be honest with you, this doesn't take long to do. This will maybe take you probably 30 minutes a week to run through the key data points that are coming out, make notes on it, and then when it comes to your journaling, note how the market reacted to those specific data points that came out. I just don't think enough people take it into consideration because if you know right instantly when it comes on the wire that a 1% numbers just come out for retail sales and jobless claims is the lowest it's been in 4 or 5 months, right? And for the market you're watching, that's going to be extremely bullish for the market you're watching. And you're quick to act in that and you buy that, you're going to be instantly on side. So yeah, fairly straightforward stuff to be honest with you. And I would say when you go to different news wires, they're kind of off ever so slightly by sometimes 10%. And some news wires mark some events as tier one data versus tier two. To be honest with you, but this is the part where you'll note which data points have the biggest impact in the market. For example, as I said earlier, housing starts and building permits were the lowest they've been this year, and yet the market didn't really care. And to be perfectly honest with you, if you were looking to make, if someone said to me, you had one strategy to make the quickest amount of money possible, with not really any risk management in place, it would be wait for standard deviations in the news for the specific markets, know the numbers really well, and when they come out something that is extremely unexpected, you go with the flows. So just another string to your bow. This, and that's the whole part of every day that goes by in trading, you get better and better, and it's important to know these things. And I asked the question, if large institutions and large funds are paying attention to these numbers, why shouldn't you? You know? And just to give you an example, if we go into financial juice here, you have the chatter that happens, right, when the Fed heads talk. And you can see that they say, I have concerns for 2024. We have cross currents. These guys say things, in essence, and you need to say, is that going to change anything as to what's happening? Most of the time, not really. Is these guys are so, uh, these guys are so, how do we say, like politically correct, or they don't really step out of line. But the guy's not going to go on to a main news wire and just say, by the way, we're not going to cut rates this year. He's not going to do that. If you watch Powell speak, he can speak for like 2 hours but doesn't say anything because he doesn't want to rock the boat. They need to wait for numbers, and the numbers that come out is what actually reprices the market. But yeah, that's pretty much it, guys. If anyone's got any questions, let me know. I thought I would try something a little bit different today in terms of doing this live rather than just doing a video on it. If you do your prep for this coming week and we already discussed unemployment claims, but then you have the PMI numbers that came out, and there's quite a lot of talking Fed heads that are coming out, which you can't really prepare for, to be honest. You need to take it as they go. I don't think you really should be trading as they speak, in case. I mean, they don't really see anything out of line, as we discussed, but I don't think it's good to be trading when they actually speak, because they can, like, you're not going to be quick enough to anticipate what they say, to be honest with you. So the main numbers that are printed in the calendar, that you can prepare for 100% factor all them in, but when it comes to the actual Fed talk that happens, I'd advise you probably not to trade. And then it comes to FOMC meetings and stuff. We've seen it the last three where the market is essentially wait till he's done speaking and then just sells off. Yeah, exactly, exactly. Well, I just decided, to be honest, Pike, to do this off the cuff um, today, and we'll probably then just re-upload it as a video, I think. Yeah, for all streams. Yeah, exactly. So just have a look at the flash manufacturing that's going to come out. So for this year, very quickly, you can see it's been 52.5. It's been the highest. And the lowest number has actually been here. This is the previous month, 49.9, 49.5. Look how much of a miss that was in forecast. It's priced in to be 51.7. So you can see if when these numbers then do come out, if you're going to be below 49.5 and then a beat on 51.7, you know, you can take that into consideration because the market will be repricing when that comes in. And if we do somehow put in an absolutely dreadful number and come below 48.2, then you better believe that that's an opportunity in itself. Okay, because the market is pricing in 49.8 is what the forecast is meant to be. So if we can remember the huge beat back above 51.7 or we plunge below 48.2, then there's going to be some repricing that comes in for them. And then unemployment claims is going to be the same. That's pretty much it, to be honest with you. So I hope you guys have a great rest of your weekend. Unless you've got any questions, we'll to cover it there. Is it pretty clear here? Does anyone got any questions about this? The reason why Forex Factory is good for this is just it's an easier way to view the graphs, to be honest with you, and it's free. You don't need to pay a dime in order to analyze this data. This has been quite an uptrend as well for the services PMI. So again, if you kind of take away a 50% reduction on that, and then if you do break below with the number that comes out below 50.9, then you better believe there's going to be a shock. And if you get both of these that come in as a shock, again, instant opportunity. I mean, last month is essentially put in the highest number here, the highest number this year, and the market's forecasting in 54, you know. So I reckon if we do put in something like 52, especially below 50.9, it's definitely going to have an effect on the market. So you then know your numbers for when this comes out in the wire at the exact time. You then know, right, if it's 51 on services and 46 on manufacturing that comes out, you're instantly going to buy, as an example. Or if it comes in a massive beat above these numbers, then you know you're going to sell. You need to understand how these numbers affect your specific markets. And the market normally is really correct when they come out. And if everything comes out in line, then there's no opportunity. If it comes out exactly as forecast, say this comes out and it's just, I don't know, 55, 56 again, then we're still in an uptrend with this. So most likely that'll still cause a bid, to be honest. You know, everyone's too busy looking at technical analysis and not trying to factor in the fundamentals when it's literally the same thing. Chris, not all the time. That works inversely for treasuries, depending on what you're trading. But as I was saying, indices is kind of a bit of an outlier. So if it's good for currencies, it's not always just negative for stocks all the time. So, for example, being that when the unemployment claims come in less than expected and there was a huge beat on retail sales, ES went bids, so did the dollar, and Treasury sold off aggressively. So you need to have an understanding of how the numbers affect the market you're trading. And very typically, the stock market likes growth. Obviously, more growth, more spending, more money for them. They tend to like cheaper money as well. Um, and by cheaper money, I mean lower interest rates. So they prefer a growth environment, lower interest rates as well. What the stock market doesn't like is, of course, a recession. So, if retail sales is people's not spending any money across the board, and then you have unemployment is sky high, certainly not going to be good for the stock market, right? But yet both of those things are actually good for currencies, depending on which way the numbers come out. And that's the thing you need to be aware of when you go into Forex Factory, is it's specifically catered towards the currency on there, and it's not always inverse. It's inverse for treasuries, but for treasuries, so the dollar and the yields go in tandem with each other, are positively correlated. And whatever, if the yields go up, then treasury markets go down, and the dollar is inverse to treasury futures. But just as a word of warning, you need to do a little bit more digging in for stocks. Yeah, Alex. Yeah, I thought I'd do something a bit different today, dudes. Yeah, we're just running over data here. So to do something a little bit different. As I really, I'm going to be honest. I think if you guys start factoring in these numbers, right, and you understand the sentiment, especially for that session, right, because the sentiment or theme for that session normally takes quite a lot to change it. You're going to need, you know, just say that the numbers come out a huge beat and it's good for stocks, and and ES and NQ go bid, right? Well, you're not really going to want to just step up and fade that, are you? When the flows are coming in, to reprice that, you want to be going with that, right? And if you don't understand why the market is going up, and it comes to a level, and you think, oh right, I'll just short this because it's at my level, but you really shouldn't, because the sentiment, the sentiment for the session very typically stays the sentiment for that session. You know, unless it's you have something like the CPI number that came out, but you need to be on the ball with that, where it actually came off in line, and then the market basically just ends up where it started because it was already priced in, just an initial move. But you'll get the hang of that. That's what happens when data comes off in line. It's already expected. It's the whole point. Yeah, no problem, dude. And here's a question: do you guys utilize any of this in your trading at the moment? No, no, you're not at all. I was covering that, Alex. So pretty much it depends for yes. It's not always inverse. So dollar and stocks is not always inverse. Um, but you need to understand like the backbone of stocks. Like, what do stocks prefer? They prefer cheaper money because they can borrow more money and basically grow their company. They prefer a stronger economy where people are spending and they have, higher wages, less unemployment, more growth. And ultimately, when they're spending money, they're buying, they're buying more Teslas and more AMD cards, more Apple phones, you know, things like that, very typically. So, and when a growth is happening like that, it causes typically higher inflation, which is then bad for bonds, good for yields. To use fundamental news, you must admit you're quite limited around this stuff. I mean, I'm not saying that you guys need to become an analyst here and print all this stuff in. You just need to know, are the numbers coming in line, or are they massively out of the normal, right? Because if you know what the low of the year is and the high of the year is, on that retail sales number, it came in and printed the highest retail sales number this year, which is extremely growth like, and that the market had to reprice. That doesn't always happen, but it's a good opportunity when that happens. Chris, you keep an eye on the data, always seems to bring some volatility, but the market always data dependent. Well, the thing is, on tier one data that comes out, like loads of people are going to be there on that day. They're ready to step up, they're ready to do business, they're ready to reprice, and they're ready to sling some size. Everyone's watching these numbers. So that's why you get more volatility. People are ready to stand up and take shots at either speculating or repricing their positions. So as an example, FOMC stay away, NFP equals maybe before announcement. I would say NFP again. Like NFP is typically one of the most whippy ones. You'll notice when NFP comes out, you normally have a huge stop run to the high, then it goes to the lows, then you maybe see absorption, then it goes back. Again, unless those numbers, like if those numbers come out in line, right? Say, I don't know, just say they're forecasted at 50, just as a random number, and they come in at 50, the market will still whip the highs and whip the lows. That's just what happens with NFP. NFP is not the best one, to be honest with you. And then FOMC, I'm not really going to advise you to trade that because you need to be extremely proficient about what Fed members are hawkish versus dovish. What did they say versus the last meetings? It's just too much upkeep, to be honest. Um, you can be much more prepared from this from the standard numbers that come out in the calendar. They come out at the same times all the time, and then you'll remember like, oh wow, this is how the market reacted last time when we went below that number. Spread is affected on CME. Of course, the spread is affected, mate. Spread changes depending on the liquidity that is available on each price. And typically, when there's more volatility, there's less liquidity in each price, which causes more spread. Which is why NQ has a couple of tick spreads just all the time because it's a really volatile asset. Lemon, is it true that market makers use news volatility to accumulate and distribute their positions? So I would say, look, so let's you know sort of discuss that. So market making firms are there to make a market, right? They have obligated numbers and quotas that they need to fill and basically not allow tons and tons of slippage. But they also need to make sure that they can manage their own portfolio and manage their book, right? And they have tons of different, subsets within that. If you're talking about the market maker that's just providing you liquidity on the bid and they get out in the offer, the reason why you see just such whippy moves when news comes out is just simply because the book is so thin. I mean, if you want to have a look at the 10-year prior to these data points coming out, the 10-year is normally like 4K bid on each price. When this data comes out, it is literally 10% of that. Sometimes even less. It could be a couple of hundred in each price. So the market can then move, in treasuries like 15 ticks, just because there's no liquidity on there. So for you to hold into these news events, you're literally just, if you hold into these data points, I'm not joking, you're literally like putting your money out to the sharks. Do not hold into these data points at all. You know, unless you're a swing trader and you're holding for weeks or days at a time, fair enough. But intraday trading, you're literally asking to get smacked. Because why? Well, you're going to get tons of slippage on your stops because, your stop is a market order. If the market gets to that area and there's no liquidity there, you'll get filled at a terrible price. But then on the flip side, you've got a limit order to get out on your take profit, which will probably get filled. So it's not like you get the benefit of it for the upside. you only get the rubbish part of the downside where you get filled bad because a market order gets you out, but it doesn't get you out at the best price. A limit order gets you out at that price, you know. But it's a good question regarding market makers. To be honest with you, and I think realistically, Globex is a fantastic example of market making and just distribution, where you draw out a high or a low in Globex, it goes up, sweeps the high, pulls back, distributes, then you need to see where it's going to go. Normally it'll sweep the low, and it'll kind of work within like a 40 tick range or something for Globex, with not really any flows. And if the market then gets really one-sided, um, then it'll tend to correct in the regular trading hours. And I would say that the theory is that you just need to trade what you see, to be honest with you. Um, if you go into these days with a bias a lot of the times, no problem with having a bias, but you need to be able to throw the bias out the window if the flows are not correct. So as an example, this is why I'm harping on about this data here. If your bias was, bearish on S&P, right, or yes, and this data comes out and there's crazy amounts of repricing happening, we've got the highest print on retail sales. Well, you need to be taking that bias and throwing it out the window. Because if you continue to short that day, you're just going to get hammered. Do you know what I mean? But without you understanding the context and sentiment for that session and why it's happening, you're just going to continue selling. Because then a lot of the technicals are then kind of out the window. Do you know what I mean? They're then no longer relevant to an extent. So Chris, the CPI seems to be a big one. Nasdaq started to sell on the 11th of July when CPI was due. It didn't stop until the most recent CPI was nearly due. Yeah, I mean CPI is one of the bigger numbers that's watched, of course, for the inflation data that happens. Um, I would say though that the market is never really wrong. To be honest, the market's going to be quicker to react than the Fed, that's for sure. And here's the thing, like the next meeting that the FOMC have next month, the rhetoric at the moment is, are they going to cut by 50 basis points or 25 basis points? And this is the thing, if they come out and don't cut at all, the market is going to go bananas. Exactly, Zedin. That's the reason why I'm doing this, buddy. And I can tell you, if those flows are coming in and you're on the ball and you know those numbers are out of whack, on like for example Thursday and you just hit the bid, like you're instantly onside. You're instantly onside 4 or 5 ticks. I actually did this on Friday with the Michigan sentiment that came out. It was a beat. It was quite a higher number that came out, and basically we sold off quite aggressively. And you can see now the difference why, right? On like Monday or Tuesdays, where there's no data to come out. So say like this is next week, right? So you have so next week we've got Monday, Tuesday, there's not really anything, and on Wednesday before this data comes out here, right? There is not going to be any gigantic moves, um, especially on Wednesday before this comes out. So you can expect balance on these days. So typically before FOMC meetings, I can probably provide you guys stats for this, but typically T-2 and T-1 for big data points that come out, like FOMC meetings, and CPI, there's not normally a huge amount of direction. So with that, with you knowing that, taking, just as an example, taking breakouts is probably not the best strategy, is it? You're better to be fading into the mean. Whereas on days where you've got loads of people there, volatility is expecting, data's coming out, you know, breakout trading is going to make more sense. We're trying to break this down into the most common denominator here, and hopefully it gives you an idea as to why some of this happens. And see, when you then couple all this with order flow and volume profile, it gets extremely powerful for you to understand what's happening. And of course, when you start making notes and all of this, you get more proficient at it. There are weeks when markets look really drained before NFP. You notice this? Yeah, exactly. Exactly. NFP is a weird one in FX, man. There's never really any real direction again, unless it's something that's out of the whack. When you're trading FX, I would even it's a completely different ball game. Futures, for example, you can lay out an say for example those numbers come out right, and I was looking to buy ES or buy the S&P, or for you the US 500 if you're trading CFDs. For me, if I'm looking to be a buyer there, I can lay out a bid on a price, and then if I get hit, I'm in. I don't pay any spread on that at all to get into that. If someone, if there's 50 on the bid and I'm, 25 in the queue and I'm queuing up 5 contracts, if they hit me, I'm in. And then I put my take profit and I don't pay any spread. Whereas when you're trading that in CFDs and you put a bid out, it needs to go 2, 3 ticks by you before you even filled. So you're instantly at a disadvantage on that. So T minus two or T minus one. Sorry, it's just like trading minus two, trading minus one, one day before, one day prior. So T plus one and T plus two is trading day, you know, plus one and plus two. That makes sense. So Chris, I was used to trading crypto, so when I switched over to futures counter trend trading, the trend killed me. I didn't realize Nasdaq and ES can just keep going. Exactly, exactly. So yeah, if you look at it a couple of days prior, the volume prior to these events and the volatility, T minus one, T minus two on these days is not fantastic on the markets. On the day of the data points and probably T plus one, you're going to start seeing more volatility and volume. Alex, how's it going, dude? How you doing? Nice of you to stop by, man. CFD brokers are such scammy regarding spreads, but it's the only game I can play at the moment. Got to deal with it. Yeah, I mean, CFD is a completely different game, to be honest. Completely different game. I would ask the question, why not futures though? Well, a good question. No, I don't think having a bias is wrong. I think that it's a skill set in itself for you to be able to realize when your bias is not right and stop continuing to crack at it. Do you know what I mean? So if you think so say for example, I would use that with CPI number, or sorry, the retail sales number that come out when ES essentially went bids, right? If your bias was short and you continue to basically try to hit into the bid there, you're getting wrecked that day, you know. Whereas if you had the view on trade what you see, you would be basically objective all the time, right? Good, Alex. That's what I like to hear, my man. Hopefully that goes well, dude. You get less fees trading. Well, I would say the fees, it's a little bit, unless you're going with something like IC markets where the spreads are really tight, you can then get rebates on the commission side as well. But when you're doing any form of props with, even the best ones like FTMO and stuff, their swaps and spreads are not great at all, to be honest. That's part of their edge, you know. Like commissions, regardless if you're trading CFDs or futures, is it's a cost of doing business. People don't think about it enough, you know. There's a reason why people buy a seat in the exchanges because they get their commissions down extremely low. Exactly, Chris, and that's the thing. You should have a rule where, when you start the trading day, don't be a potato and trade what you see. Yeah, trading futures via prop is you know, it's a slightly different market. I mean, it's pretty much the same thing, just the spreads are different, and you don't enter in it's in ticks and points rather than pips. And you can only enter one contract at a time. You can't enter like zero point 0.4 lots or 0.01 or whatever the case is. It's slightly different. No problem, Alex. Have a good day, dudes. Good luck in your trading next week, man. But let me know if anyone's got any questions about this data. Does it make sense? Is it something that you think would benefit you incorporating into your data and into your trading, at least so that you understand the flows better? I mean, it's only going to take you probably 30 minutes a week to jot down those numbers, probably get a highlighter, write down the range. If it comes out within this range, it's good or bad. The green highlights for the buy, the red highlights for the sell, depending on the numbers. Do you know what I mean? Also get some sticky notes and write "Don't be a potato" and stick it to your forehead or the screen. Because there's so many little small parts that you need to take into account for trading. So many things. And every year that you do this, you look back on it in the year before and you think, holy smokes, I wish I incorporated that sooner. And it's not always about adding an extra indicator to the charts. That's not it. When you first start out, that's what you think. I need to get the sauce. But actually, some of the tweaks you'll find is the statistical edge in the data you're trading, improving your executions and stock management, journaling, understanding fundamentals and market sentiment. All of that's extremely important. It's not always about moving averages and iceberg orders, for example. Yeah, it definitely helps with it. That's the whole point here. And this is the thing in trading that I can't teach people is experience and doing it yourself. I can really only, I don't know what the saying is, teach you how to fish or whatever the case is. Do you know what I mean? Understanding all of the small things put together because if me showing you a rectangle on the chart and then you sell at the rectangle, it is not it. Do you know what I mean? That's why it's trying to get you shorten your learning curve to slowly add in the little chunks that get you closer to your goals, man. So your main problem for trading is not understanding the context enough during so exactly, mate, and that's it. And one thing I would say is the sentiment for that session, it needs to take a lot for the sentiment to change. And by the sentiment to change, I mean the market to go the other way. If it's going bid aggressively, you're not, if you want the market to go down and the flows are extremely aggressive lifting the offer and you're thinking the market's going to go down, well, you also need tons of other people to also think that way. It's not as probable. More likely people are going to be buying than they are selling. And you need to know the reason why. And if the reason why is the data is now shock factor, we need to reprice, then you should just be going with that. Yeah, Alex, I think once you're ready, take your time, dudes. It's a good transition to futures. The one thing I would say about the transition, you need to understand the specs and products that you trade. How much is the tick size? Are you going to trade micros or minis? And the one main advantage about futures over CFDs, centralized book. Volume is centralized. So I'm in the UK. Whether you're looking at this in the UK, Europe, US, or India, we all see the same stuff. Do you think data right now is being manipulated? A lot of people in our Discord, and that's the case with elections coming up. Ugh, I mean, just again, Chris, trade what you see, man. You know, trade what you see. If the banks are repricing on these numbers that are coming out, John or Paul that thinks the numbers are manipulated doesn't matter, right? Trade what you see. Who cares that it's manipulated? I'm not. I'm here to trade and to make money. I don't care if the numbers are manipulated to help Trump or whatever win. It doesn't affect me. And to be perfectly honest with you, I don't care that the unemployment claims were less or higher. I just know that knowing these numbers provides me an edge, to be honest with you. So I would say again with all of this, stay focused on your stuff. Be objective in what you're seeing. Understand the flows and the sentiment for that session because John, Paul, and Kyle, the fact that they think there's a conspiracy theory going on, is that going to change the amount of offers that have been lifted for that session? No. So, you know, all these little things where you see just kind of slightly warps your mind a little bit, and it kind of puts a little bit of the parrot in your shoulder nipping away at your ear saying, this is maybe not correct, I should be doing this. Do you know what I mean? When actually, screw that, just trade what you see. Focus on your own stuff. Focus on your own journal. My profitability in my journal and my profit factor is absolutely no bearing on anyone else, for example, right? And if I gave someone the exact same strategy and told them exactly how I traded, they're not going to have the same profit factor because everyone executes differently depending on how much sleep you've had, depending on multiple different factors for that day, right? Hopefully that makes sense. I'm just not wanting to get too distracted with it all, dude. Do I look at the liquidity when data releases? It's just before the numbers, the book is thinning out. Sometimes you see a bit further from the price, still big liquidity levels, which often get filled. Um, well, put it this way, right? And I can tell you this from experience, and this is just I would probably say common sense. Looking at order flow and looking at the book is very much like sitting at a poker table, right? Now, you're not going to give away your hand. You're just not going to do that, are you? You know, and this is why iceberg orders are a thing. So, say the market is going down aggressively, you're not going to lay out 2,000 on the bid. If you get 2,000 contracts to get executed, you're going to wait till the market gets to that level, and you have an iceberg order that says, right, when 50 hits into me, I'll absorb, continually refreshing till 2,000's done. If it takes me out, quickly, and I've got more to do, then I'll continually refresh, and then you'll hold the market will stop and be held up for that. But no one knows until the market gets to that level, and that's back to the theory of the poker table. You're not going to sit there and literally say to people at the table, by the way, guys, I've got pocket aces, I'm all in. You're not going to do that, are you? You're going to play the table, play the game, you know, try and edge out the best price, the most money, the most profit. Same theory. Um, but I think you see how thin the book gets. I think you need to wait till the market reprices. And again, if you want to be playing when these data points came out and they're really in whack and you want to go with them, and by all means have a crack. Because when you get this right, you're going to instantaneously be on side. Like there's no doubt about that. If you realize this data comes out within, I would probably even say 4 or 5 seconds, you've got that amount of time where you can still buy and easily get a number six with it. Yeah, I would say so. I would say that, yeah. I mean, the heat map, honestly, mate, since that cloud algo has showed up, or the range algo, it's not been as useful, to be honest with you. I know the bookmap has a filter that you can maybe take it out, but this current market regime that we're in is more sweeps and icebergs rather than liquidity shown at each levels. The market's not thick enough. If you notice the VIX below 15, the book starts to thicken. So there is slightly more value in the heat map when it's slightly thicker, but when it's thinner in the last couple of weeks, it's just useless, to be honest. No one's laying out hundreds of contracts, because the market will just go to that level. They just do it in icebergs, and you would do the exact same. You would do the exact same if it was you, because you've got the problem where when you get thousands of contracts to fill, it's no longer about, can I make the market go my direction? Of course you can. Like if there's 300 on the bidding offer for the next four ticks, and you've got 2,000 contracts to buy, well, obviously you can make the market go up. You can just lift everything. But why would you do that? Because then you're getting a rubbish fill. You would want to start absorbing some, working some, lifting in some, because you want to get the best price. So they don't necessarily have the same objective of us. Of course, they want a number of handles when they're trying to make money, but it's more about the efficiency of the fill, and of course getting into the position is hard, but then how do they get out? Because again, if they're up say 10 points and they want to start working out the position, they can't just go market sell 2,000 contracts, because that will take the market down like another 2 or 3 points, right? So they need to start spending a little bit more, to get it to areas where there's liquidity there, so they can try and get out more on the offer and get out of their long positions. Does that make sense? And basically, when data comes out, it provides them ways in order to do that very quickly. That's why there's loads of volatility that happens. I would say probably after the 5 minutes that happens, there's loads and loads of repricing. Any book recommendations? Um, no, not particularly. I mean, the age-old read Trading in the Zone, but to be honest with you, if reading Trading in the Zone was the answer, then 80% of day traders wouldn't fail, because probably majority of people have read the book. So my number one advice to people is stop risking so much and be there for the next quarter, never mind the next day, is my key advice. The longer you can stay afloat and stop boom and bust cycles, the better chance you've got of being profitable. And if I'm honest with you, a book's not really going to say that. I'm going to tell you that. Spoofing. So, uh, I mean, again, different market regimes. When a market is thicker, there tends to be more spoofing because if they can, how do I explain this? So, say for example, you're 200 on the bid and 200 on the offer, right? Someone trades 50 into the offer, right? And then there's only 150 left. What they'll potentially do is the price that's below the current bid, they'll maybe add on 500 contracts, right? Spoof it. So chuck that on to make it appear that the bid is stronger below the current bid while they're ticking into the offer. And while they're ticking 50 into the offer and algorithms say that there's a strong bid below that, they will likely pull the other 150 contracts and then you've ticked up with hitting 50 contracts. And the guy below that is just distorted the book by just creating a spoof. And then that may allow them to get to a certain area to start eking out that extra couple of ticks. That's all spoofing is. That it's just showing strength on the bid or adding on or weakness onto the offer to show strength on the offer to try and distort the book. That's all it's doing because algorithms are, especially the really tight ones, market making ones that are on the bid and offer, if they see aggressive amounts of strength behind them or below them, they'll likely add on because they know they've got some protection behind them. And that's really what it is, very typically, and that's going to be enough with how volatile ES is these days to basically get it an extra couple of ticks. And when you've got 50, 100 contracts, an extra couple of ticks is a lot, you know, and that's really what spoofing is. Um, and a lot of the time this comes with experience where market making firms now with queue positioning are layering every price with pretty much the same bid and offer. So when they hit into the next price and bids and offers get pulled, uh, you know, it allows you to see that actually, the offer or the bid is not as strong, especially if there's not any icebergs there. But you need to train your eye for that. It takes some time. Exactly. Yeah, that's a good one. That's a good one. And to be honest with you, for me, I've been doing this for so long. It's more of a trial and error game that got me there rather than, reading materials and stuff. And that's the reason why I'm sort of doing this is if you can take some sort of nuggets from this and apply it to your trading to really just help you keep in some good trades, stop taking so many bad trades, change your perspective, understand why the market ebbs and flows. And I can tell you it's certainly not buy side and sell side liquidity that makes the market ebb and flow. In the end, you have to put trades in the journal, man. grow this habit. Yeah, exactly. I mean, there's a I don't know if you've got a journal, mate, but there's a journal in the link of this description to TraderSync. You can try it for a few weeks for free. And really, the objective of that, I think, if you're trading on MetaTrader or CTrader, you can literally just connect it to the API and it'll export your trades automatically. I don't know how efficient you are with admin, but for me, never been great at that. So, I've always wanted something where I can export my trades, and I still keep I keep a very standard, diary, pen and paper to quickly write down my notes and thoughts for the day, and then I export my trades and then write down my overall performance. And as a question, let me know, are you guys journaling or not? Like, or do you kind of, only go about it sometimes? How meticulous are you about it? What are you doing in your journaling? Nice. So you're keeping it simple. Well, that's the thing. The number one thing I would say, and this is just I've tried all this, of course, as well. If you can do things where you can keep a Google spreadsheet and write down entries, averages, max favorable, max adverse excursions, and everything, then more power to you. If you're scalping and you're taking multiple trades a day, it's going to be pretty difficult for you to manage that. So for the price that these journaling softwares they are, I think I pay 30, $40 a month or something for like the middle package of TraderSync. Allows me to export my trades from both Teton and RTrader and import them in, and it does everything for me. And it works out all, how many ticks went against me, how many ticks went for me. I can see how I'm performing, what's the best times of the day that I tend to make money on certain times, and then extra journaling is then things like, what was the volume like on days prior to FOMC and tier one data. And that's why I'm telling you that typically these days end in balance, so it's better to be fading extremes rather than going for breakouts. That's what I've noted for years of just watching markets. But I can tell you one thing, if you're not journaling, you are missing out. Spending an hour with your own journal is better than spending 4 or 5 hours digging out for the special indicator. Because your journal is what your behavior is like when you're actually in a trade. Um, and you can be the best analyst in the world, the best chartist, of the best holy grail setup. But if you can't manage any trades, and you shit the bed when you're in a position, you've got no chance. So you need to monitor that. And if you don't monitor it, here's what happens. You suffer from recency bias. You don't know how you performed last jobless claims. You're never going to remember that if you're taking multiple trades a day. I can't even remember what I did yesterday or 5 minutes ago. Never mind what trade I took an hour before last FOMC meeting, for example. Um, so give yourself a fighting chance. You know, get yourself prepared, have the right mindset, understand the competition, realize how the market ebbs and flows, and journal your stats. Because you better believe that your competition is journaling the stats. And if I could tell you um, there is 10 people currently watching right now, okay, 11 including me. Only 1 to 2 people in this room is going to make this in the long term. And you need to work extremely hard and be very diligent and know your numbers and know the competition in order to give you the best chance. Hoping those numbers are going to be higher because you're all going to do that, and we're going to fight against the statistics of 80% of people fail. But my reasoning for why the 80% fail is because people are not giving themselves the best fighting chance to succeed. Is typically the case. Because you better believe that humans are not even doing this at the large firms. They'll now be having the likes of AI companies will be coming in to analyze the strengths and weaknesses and where threats are in their portfolio and to tell them at certain times of the day and certain days of the week as to how they're performing, and then they'll be executing on that. Good, Alex. Nice. Continue journey, mate. And the thing is, everyone who starts, they lose a couple of years by strategy hopping. Everyone does it. Strategy hopping is the number one killer for success in trading, along with ICT. Well, the thing is, mate, if you wanted to be a doctor, you would need to study for 6 to 8 years. Why would trading be any different? And it's very sadly, a lot of the time, the skill set that you learn is actually doing the job itself. If you spent 10,000 hours doing the thing that you're doing, which is what is typically deemed as being an expert. And as the old saying goes, if you do the same thing day in, day out, but expect different results, it's a sign of madness. If you're currently in that cycle, you need to change, and very typically that's going to be from analyzing your journal. Musty, hello, hello. Yeah, Chris. Well, I can't really help you there, mate. I would say um, volume profile and order flow is going to be your friend. You need to determine yourself what markets you want to trade, what your risk tolerance is. Do you prefer more volatile markets like NQ, or do you prefer slower moving markets like treasuries? How many trades you take a day? How do you perform when you're being in a position? You need to kind of build a framework around it. Um, and again, understand the context for the session. But realistically, a strategy is very simple. You're either going with the trend for that session or you're fading the trend back to the mean or average traded price for that session. That's really all it boils down to. Throwing in a million different acronyms and indicators in it is just overcomplicating it, to be honest. Well, the thing is, you've got to be willing. I think when you're this deep into trading and you've been doing it for so long, um you need to see it out. But if you're not profitable right now, the number one thing I can tell you is you need to know the product more that you're trading, understand data points as to how that impacts the markets. What days is going to bring the most volatility? Do you prefer days with more volatility or not? And how is your edge? If you're not currently profitable, well, do it over the next, 50 trades and see how you perform. Because if you're not profitable over the next 50 trades, then most likely you need to tweak something, you know? Should be a decent enough sample size for you to at least see there's some sort of profit factor in it, and then you can scale it from there. Because once you get there, scaling it is not hard. You can easily increase size. Maybe not in NQ, but in ES and slightly thicker markets, you can easily scale it, no problem. Musty, good question, dude. So I do, but I factor in what data is coming in. I like to know the numbers as to what's happening. I covered that in the start of the stream. If you have a look at the retail sales number that came out, we discussed this, but it's the highest print that came out this year. And as well, the jobless claims basically come in less hot than expected, so extremely growth-like. So we saw a bid in currencies and a bid in equities. If you were on point and studied for those numbers, you could have instantly lifted the offer when that came out, and you'd have instantly been on side. I still think that you've got probably 4 or 5 seconds in this day and age to be able to stand up and make a decision. Um, but I'll caveat that the data has to be out with the norm. It can't be in line, because if it's in line, you're most likely going to see some whip. Hey, Alex, you can definitely see the madness in the journal, mate. That's the thing. Well, Chris, that's the thing with Top Step. One of the only advantages that I see with using that Top Step platform is the commissions are lower. Uh, you know, I've been trading with them for a while, and I actually get lower fees with my own broker, right? Than Top Step provide. To be honest, they need to sort that. Um, they go on about they're from Chicago and they can do everything along those lines. Well, they need to get a seat because their commissions are shocking. Commissions, it's not spoke about enough, but commissions is taken directly out of your pocket. You're paying on, if you're trading with a prop firm, you're probably paying the guts of 430 a round turn on ES. You know, it's the whole point of trading with a prop firm should be more buying capital and lower fees. You shouldn't be able to go to your broker and get lower fees than you should with a prop firm. That's completely flawed. Because if you're trading 2, 3 contracts, or even heck, hopefully more than that, and you're saving a couple of bucks, a round turn per contract, and you're doing 40, 50 round turns a day, you're saving a couple $100 in fees every day. That's 4K a month. That's the way it should be. And that is a direct cost to your business, especially if you're planning on scaling it and you are looking to scalp. It's extremely important. So, Alex, you're very stupid in the beginning, trading indices outside of New York hours, not knowing about news, switching. Yeah, I mean, I would, unless I would probably say it would make sense for people just to not even trade Globex, to be honest with you, unless you've got a specific strategy that you can utilize, to be honest with you. But you need to trade when there is flows and money there, just because the market moves more. It's very simply. Musty, you see, you never actually thought about analyzing market news. You feel you need. Well, you do, mate, but you're not really looking to trade things that are in line. You're looking to, so just very simply what you're seeing on the screen here. So the flash services PMI that's come out, okay, for next week, this comes out on Thursday. Just very quickly, it's forecasting 54. The previous was 55, and you can go here and it says it was revised from 56. So actually a slight downtick from the original number. That's the revision that's come out, right? But you can see that that's been the highest print though this year, right? It's been 56. Now it's actually 55. So it's still higher. But we've had a nice uptick here in the last 3 months, you know? So if this number comes out, it's forecasting 54. Wish I could get a line out here, but we're looking to be coming in here at forecast. If this comes in and it's a huge miss, let's say it comes in at like 52s, or heck, even below 50.9 is the worst print that comes out, right, for this year, you better believe that's going to have an impact in the market. And you go into these numbers knowing, right, if that number is above 56, I'm going to be a buyer, and if it's below 50.9, I'm going to sell, and you then hit it. Because you know that people are going to need to reprice. And if you're hearing that very quickly, and then you're also looking at the flash manufacturing that comes out, and then unemployment claims. So if they come out and these numbers are mixed, you need to quickly adapt. But if all three of these come out, say they come out and this number's 230, this number comes out and it's 48, for example, you can be quickly hitting or lifting. This depends. Yeah, please don't bring up fair value gaps. So you trade. No, I've got a question for you. How are the fills on Top Step X? Are they real? Are they sim? What's the setup? I mean, Top Step X doesn't even have inside prints, which is crazy. But reading the flows and news here, I'm not some sort of mythical analyst here. I'm just showing you the numbers, and if they're out of a norm, then it provides an opportunity. And to be honest with you, if this comes out probably even at forecast at 54, um, I would like to probably see it come in at 55 still, because you can see the last 3 months it's been an uptick. This has been the highest it's come out since May of 2023 here. So May of 2023 is 55.1, but at the time until this was revised, this has been the highest print over a year that came out, which is important, isn't it? That would be important for you to know. And the market will react to that instantly, of course. Do I think you can make a career without any interest in news data? Of course you can. Of course you can. I'm not the complete source of truth here. There's tons of people that will only be technical, analysts, and and only using charts and make it, of course. But the point of this is to challenge that, where on specific days when these news reports come out extremely out of standard deviations and the market's going bid, and you're a mean reverting trader, surely on those day types when that happens and you know this data, you're not going to be fading that, are you? That's the whole point of me doing this. It allows you to understand that when the data comes out, why is the market going up or going down? And again, that leads to context. Surely you would want to know as a person why the market's going up and down, not just there's flow coming in. I don't know if you're that, if that's the kind of person you are, you could just have the view of where I don't really care what news comes out. If buyers come in and lift the market, then I'm also going to be buying. You could just be saying that. But then, to be honest with you, you're going to get caught out that way because there's times that the market can whip, like we saw with CPI that came out. as well. It was pretty much in line. The market instantly went bid and then we sold off. And yes, and it did the opposite on bonds. And actually, when that number came in, I was actually buying the drop in bonds because I thought this doesn't make any sense as to why the numbers are actually in line. If anything, it should be good. The Fed should now be cutting. You know, but then on the flip side, when the data come out on Thursday, you know, it's a I would not be fading that. I'd be going with it because it was so bullish for the economy. And this is the problem that I have, right? And I did a video on that, Lumen, and tons of backlash from people saying, "Oh, you've not did the full three mentorships and you're not understanding it's not all about fair value gaps." When have you ever been in a public forum, right, where anyone has ever said there's a fair value gap in the 15-minute, but by the way, bear in mind about all these different contexts that happen? No one. No one says that. They just call out and say, "Oh, there's a fair value gap in the M15 time frame." Oh, great. You know, And the trouble is, I'm going to be completely honest with you. If you've watched that guy's recent streams, he's got that many lines now in the charts. I actually watched that when the unemployment numbers come out the previous week. I watched the stuff for 10 minutes. And he had that many lines drawn in the chart, just random lines, right, at potential sweet points or support and resistance areas. And he's basically now structured that in a way that regardless of what the market does, he can say, they went for the buy side liquidity, or they went for the sell side, or would you look at that? They went to one of my lines and it's respected it exactly. He's now structured that in a way that it doesn't really matter what happens because he's got that much things that's impacting the flow for him that he can just say one thing and another happened and that was the reason. That's the problem with that whole concept, to be honest with you. It doesn't take into account any news or any fundamental factors. Doesn't know any order flow or any size that's actually hitting the market. Doesn't know any volume that's actually going in to create those candles. Doesn't know any of that. It's just lines. And this is quite funny. As a stat for this, I read some studies on this before. If you go on to a chart, right, for the next week and you literally close your eyes for the day and put in random lines, just support lines for that day, right? And count how many times your random lines with no technical analysis respected. It's probably going to work out that it's somewhere like 50-50 coin flip. Musty, how do I think US elections will affect the markets? Okay, well, I think if Trump gets closer and closer, essentially Trump promotes more growth, so higher inflation, which is typically going to be better for the stock market, bad for bonds, good for currency, typically. Currencies prefer higher inflation, so does yields, of course. They prefer higher rates. So, and then on the other side, I don't really think. I mean, we're currently in the democratic cycle, or whatever. So I don't really see how it's just currently going on. But I would say that Trump is perceived to be slightly more bullish for the stock market. But realistically, the Mag Sevens is ruling the stock market anyway at the minute. We saw a bleed in them the last couple of weeks, which is why we had a huge pullback. So Chris, use a hybrid system from trades. Reality, it's PVSRA and market maker. Strategy works well, but I want to add with it because we'll need to see what's going on and inside candles. Yeah, exactly. I mean, at the end of the day, right, we're all here to win. The problem I have with a lot of the strategies that's taught on YouTube is it's so the it's so subjective, right? And a lot of it is not understanding the complete context and sentiment of the market. Um, a lot of the time. And realistically, any trader can take, a strategy with a profit factor that's positive, journal it themselves, and make money. It's all down to the trader at the end of the day. Yeah, the hindsights are crazy. Um, it's just the guy is literally made a living off of streaming random charts and talking nonsense, to be honest. Um, yeah, just the way it is. The guy's been doing it now for 10 years, and he's almost created a trend. The hardest part that I have when new people start and then they just say, "I'll go and learn ICT." That's the problem, and then you lose 2 years of your life. And if you can be profitable, then great. But the rule is still in play. That he has, say, everyone that follows him uses the setup, right? Probably about 900,000 of people following his setup are not profitable. Why? Because it's got nothing to do with the setup, it's to do with the trader. If his strategy was he was the best trader in the world, the guy would never have a losing day. Sadly, it doesn't work like that. There's no holy grail. I've seen those charts. Is that, yeah? And also the other thing as well is the more and more streams and mentorships and stuff that happen. There's more acronyms introduced. I mean, there's an NWOG or whatever the heck that even means now. Do you know what I mean? I can tell you one thing, it's the same stuff that I do every day. In 6 months' time, I'm not going to introduce another ridiculous acronym. Do you know what I mean? It's the same stuff. The market's always been the same. The things that change is the market cycle in terms of how thick the bid and offer is, the liquidity cycle, is what Fed cycle we in. Is it a tightening cycle? Are we on zero interest rate? What happens? All of that impacts the market. It's nothing to do with adding in an extra indicator, which is the problem with a lot of these YouTubers tend to do. Rather than actually understanding that you need to adapt, it's, well, that's not working. Let's chuck in another indicator or another term. Yeah, exactly, Musty. That's where, did you see? I thought it was quite funny. Trump, when he was getting a lot of traction to win, he tweeted Powell and was like, "You better not cut. You better not cut those interest rates, buddy." Yeah, exactly, James. Exactly. If you're into that, just trade the strat. If it works, happy days. But it's the problem though that it's like, it reminds me very much of like being a vegan. You know, you don't need to ask someone that's vegan; they'll tell you they're vegan. And it's the same with ICT. You don't really need to ask them about it; they'll just tell you that they trade ICT. And then they'll go on about how, you should be trading it. And it's the best thing since sliced bread. The guy created fire. The guy created a sweep. The market goes down, takes some stops, and pulls back into value. Oh, it's buy side liquidity. I created that along with the algo. Well, that's the thing, Alex. I use some indicators, but it's mostly around about volume. So I use volume profile, if that's really counted as one. I then use standard deviation bands of volume profile. And then I like to know if a market has moved an average range for the day, so an ATR amount. Um, and that's pretty much it, to be honest. Everything else is order flow based in terms of depth of market and maybe a footprint thrown in there. Yeah, exactly. I think when Trump took a bullet, I think that the image of him blood running down the face, holding the arm up in the air for the states is definitely helped his campaign. That's for sure. But yeah, any day it doesn't really impact my setup, and all I need to know for in terms of the markets is he's typically going to be good for stocks. Causes growth, which is typically higher inflation, so yields are higher, and treasury futures is inverse to that. So that's all I really need to know. Hey, buddy boy, how's it going? Rob, what's happening, matey? I thought we'd do a little bit. I mean, the stream has turned into another ranting sesh, but we're running over some market data and how to take advantage of it if a number comes out of whack, so you're either instantly hitting or lifting. But yeah, no fishing this weekend. I need to go to London next week, next Thursday, Friday, so I won't be streaming next Thursday, Friday. How's your weekend been, dudes? You been doing anything exciting? Couple of beers. Have I tried the heat map? Yeah, I mean heat maps are okay, mate. I would say that uh I would say they've not been as helpful in the last 6 weeks, just because there's the cloud algo that's operating in ES. So it's just depending on what the volatility is, it's about 8 to 10 ticks away from price. So you just need to bear that in mind. And in this market regime in ES, it's more catered towards icebergs rather than just showing the hand on liquidity, to be honest. Slightly different. Crypto is just a buy and hold setup, mate, to be honest. Yeah, exactly, James. I was going into a rant, yeah. Yeah, exactly. Yeah, exactly. Exactly. Like, the UK is some joint, man. I didn't get any of that in Scotland, obviously. I didn't have any of those problems. But then, I can't get any sun here. It's like it looks like it's about to rain here today. Yeah, I think I might have a few beers later. Take it easy, see what's happening. There's a time in crypto just before COVID when top five pairs or so was almost perfectly correlated with BTC for intraday trading. Very nice. James, so the trouble you've got with that ghost algo, if you've seen it on the book, you watch any live streams and you'll see it. It's just the starting price. So, you know, I think it's something like 300 contracts on the bid and offer, like maybe 10 ticks away from price. It's more or less depending on basically what the VIX is at. So it's clearly a volatility range algo as such. And the trouble you've got is that showing as large orders on the heat map, but it's not real. It's just there to distort the book. One would even say that it's probably there just to ruin the heat maps, to be honest. And that's what I'm saying is no one is showing their hand on the limit anymore. They're basically just iceberging in. So it's slightly different regime. Whereas go back 3 months, the liquidity was a bit more trustworthy on the bid and offer. Um, typically, mate. Yeah, the Michigan number was good on Friday. Rob, I traded that actually. As soon as that came out, I was instantly hitting. When that came out, I beat on the number. I think the 12 month was in line, and 5 year inflation ticked up a 0.1%. If I remember correctly, it was 2.9 versus 3% coming out. So yeah, it was pretty good. The market didn't even bat an eyelid to the housing stats and building permits that come in. Actually, we sold off after that. But yeah, it was a pretty good day actually. I can't remember how many ticks I took, mate. Something like 17 ticks or something. Nice way to end the week. But yeah, it was a good number. It's a good number. Um, I'm starting to think like when these numbers come in, the shorter end of the curve tends to move more, but then uh, the commission and fee structure's not as great. Lower end of the curve, and you need to be hitting more size, so it kind of defeats the point, to be honest with you, because they tend to move more. I think, you know. But yeah, it was the flows were pretty good when that came out. Oh, is the sun there for you? Jeez. Jeez, well, that's not too far. Last time I was in Newcastle, I got a boat from there to Amsterdam. I was going to a conference in Berlin. That was the last time. Do I think trading will become harder in the future? Nah, I've been saying that for years. Um, I would say trading is very much like any other business, that you need to understand your competition, you need to understand innovations that happen, and you need to be willing to adapt. Just because you make money for something in a 6 to 12 month period doesn't mean it's always going to be the same. So you need to always be just vigilant of what is happening, and that goes if you're selling Mars bars or buying bonds. You need to understand consumer trends, what's your competition doing, you know. At the end of the day, you need to be, you need to have an entrepreneur mindset to do this. Typically helps if you've run businesses in the past. I'd for sure, and the number came as expected. So sure. Oh, you just hit the whole thing. I can't love it, Rob. You just smashed the whole curve. Oh, I like it, dude. I like your balls. Well done, mate. Well done. Cracker. To be honest, mate, when those numbers come in, and they come in a beat like that, it's only going down. And the thing is, bonds are more, as you know yourself, man. Like the bonds are not as whippy like that. If the number comes in a beat higher than expected, and it's bad for treasuries, like it will sell off. You know what I mean? It doesn't then tend to go down and whip back in your face like ES would do. Yeah, that's what I was saying. At the shorter end of the curve, 5 year absolutely nuked as well. I think on the job numbers and higher retail data that come out, it moved like 50 ticks or something. Yeah, and as we know, mate, there's an initial influx that happens in the market, but that maybe get revised. But you're playing the volatility at the time, right? So you're not really caring what happens out with that specific session. To be honest, that's the whole point of the financial data flows that come in for that current session until it's revised. There's volatility that flows in. To be honest, a nicely done, good trade. That well, as you expect, of course, the longer end is not going to move as much to the daily fluctuations per se. But still, if you got 8 lots on, man, it's a good whack. But yeah, I thought we'd do something a little bit different today with the stream instead of doing a video where it's edited and stuff. I don't know if this is beneficial to people or not in this way. But anyway, we'll probably look to wrap it there. If you guys want to support the channel, click on the link. Tell your friends, family, and dog about the channel. That'd be much appreciated. Or if you got any other questions, let me know. So you search for CFD broker with bonds this week, and I have found one offering bonds. No, no, absolutely not, mate. No. If you're going to trade bonds and notes, you need to trade futures. You're literally going to get abused if you trade bonds on CFDs. It doesn't move. I don't know if a 3 pip spread is 3 ticks. If you're offside 3 ticks in treasuries, you've got no hope. None. I'm being completely blunt with you here, mate. But if you're to trade treasuries and bonds, the objective is that you get in on the limit, you don't have any drawdown, and you're taking, 1 to 3 ticks depending on the day or trade. If you're instantly 3 ticks offside, you've got no chance. You've got no chance, mate. So yeah, scratch that idea. Really, if you're trading CFDs, you need to be going with a good broker that has spreads that are literally nothing. Make sure you're getting rebates on your commissions, and that's pretty much it. It's the only way you've got to get something that's slightly fair, but it needs to be a really really tight spread. So in essence, if you're trading like euro dollar, dollar yen, cable, you can maybe get either at no spread or zero point 0.1, zero point 0.2 pips or something. Thanks, Musty. Hopefully enjoyed the stream, dudes. Exactly. Well, there you need to get the problem with the targets as well. You're literally. I hope that's not ticks, because if they're counting a pip, I don't know how they're counting pips in bonds. Um, but if literally that's a mugs game. 3 ticks offside instantly, and then 3 ticks, for you to get out. I mean, the 10 year is in a 4 tick range for hours at the time. You know what I mean? Like, to be honest with you, that structure with them is that sounds very predatory, and the only people that are going to do that and trade that on CFDs, unless the 3 pips is not 3 ticks, is people that don't know any better. They're just taking advantage of people. That's all they're doing there. Again, it's back to the chance. It's back to the point of giving yourself a fighting chance. If you want to scalp, you want to have your spreads as tight as possible, i.e., none. And if you get in limit and features, you don't pay any spread when you get in at a limit. You get hit, you get in at the exact price. If you're in and it goes a tick in your favor, you're a tick in your favor. You can get out at that tick as long as you get filled, of course. Yeah, exactly. But how do they class that though? Because like what the minimum fluctuation is a tick. So how can they? Do you know what I mean? Like a minimum fluctuation is a tick. So that doesn't. Do you know what I'm saying? It doesn't make any sense. Um. Yeah. Well, that's the point. The movement is meant to be chopped. That's how we like it. We like a nice balanced market, no real move. We can scalp a couple of tickaroos. The commission's in your favor. You know. And then when you do get some good moves, they're typically pretty predictable and readable, and they, they don't tend to be as whippy and whipsaw and mean revert as much as treasuries and so on. Sorry, as ES or NQ. I would probably say treasuries across the board, whether it's the Boon Bobble or Shats or the 5 year, 10 year, or 30 year, is probably the most commonly traded asset class amongst traders that have been doing this for a long time, mainly because they're consistent assets and they don't go through the same cycles as what ES does. I mean, ES is literally a completely different product to what it was 2 years ago. And as we can see with how the volatility changes, it's changing on a weekly basis. Last week it was like 30 bidding offer. This week it's 100. You know, you need to be able to, first thing, even understand what that means, and second of all, realize how that affects your day-to-day targets and ranges. But whereas treasuries is pretty consistent, it's one of the only. Granted, the 30 year it's thickened up a little bit prior to the last couple of years, so on. But they're still pretty much the same. They don't. It's not like one moved, 20 ticks and now one moves 80 or whatever. Do you know what I mean? It's not like that. They're the most consistent assets. Yeah, no wonder, mate. I mean, everyone does. This is the thing. Volatility is good if you're on the right side, but not so if you're on the bad side. So you just need to take all that into consideration. Everyone thinks the market's moving a lot, then great, you can make more money, but unless you know what you're doing, it just equals more risk. And if you don't realize the volatility's there originally, you take a huge hit on your full clip, which for a lot of the time will tend to put people into a spiral, then they over leverage, and then before they know it, their account's dust. So this is why going through different market cycles, different regimes is extremely important for a trader because they understand, they know what to expect. Had someone asked me questions before, you know, I don't know if it was yourself, that can you be profitable after 6 months of trading? My question that would be is, well, yes, for the current period, but not, you're going to go through periods of drawdown because you don't understand different cycles, different volatility, different Fed regimes, easing versus tightening cycles, everything along those lines, Anyways, hope you guys have a great weekend. From there, so for NQ, a 5 minute candle fluctuation was basically almost my target. Yeah, well, it's crazy how NQ is a really difficult asset to trade, mate. Extremely difficult. Um, Extremely difficult to be honest. And yeah, it's the one that people trade the most. Same as the DAX. It's the DAX on the Eurex side, DAX is quite a bit like NQ. I'd say it's actually not as bad, but it's a bit crazy too. Anyways, guys, hopefully have a great weekend. And we'll see you on Monday. If you've got any questions, let me know. We'll catch you on the other side. You guys take care and let's have a good week next week. No problem, Alex. Take care, guys.